I would steer them to the two things that have been discounted the most, that have the higher potential upside. It depends what their their objective are. But let's assume they're relatively young and want to make capital gains. If they're relatively young, want to make capital gains, then the two areas that have been massively discounted are both crypto and the kind of very growth end of technology. And why those areas are, they're both in secular uptrends, right? Technology is not going away. The EV revolution is not going away. The autonomous driving is not going away. Space exploration is not going away. AI is not going away. They're accelerating, right? So if you've got this trend of adoption and rising prices over time in the share prices, and you're right at the bottom of that trend, you kind of know that this adoption is going to continue. There's no way that technology doesn't continue. So therefore, it gets incredibly cheap every day. It doesn't go up over time. And a lot of this stuff is down 80%. Things like Shopify or whatever it may be. So that gets really interesting. And crypto's the same. It's even got a faster, steeper curve over time. If you remember, we've just talked about risk, where the low end of the risk was owning bonds and the high end was buying crypto and technology stocks. The same applies in all assets and all asset classes. So taking crypto as an asset class, so the least risky, the least volatile, the safest is Bitcoin. Still goes up and down 60 or 70, well, 75%, I think, peak to trough. So you need to be aware of the volatility, which is why leverage is not very useful in this space. It always seems attractive when prices are going up, but you get utterly destroyed when they go down. It's too volatile to use leverage. And I always say you don't need it. If we're talking about 10x, 20x returns out of Bitcoin itself or Ethereum or some of these big ones, why do you need leverage? Really? You're trying to make 100x on your life savings? Are you mad? I mean, you don't need to do that. These are big opportunities. So then when you're looking at the risk, what happens is people they suffer two things. One is the illusion that, Ethereum's at $2,000, whatever the number is, or Bitcoin's at 20,000, 30,000. I can't afford one, right? Which is a complete misunderstanding. They all fractionalize down to like 8 decimal places. What that means is you, me, the 23-year-old who's got $50 a month to put in the crypto market can all put the same percentage of our disposable income in and all benefit to the same percentage, which you can't do in other things, right? There's a lot of things in most financial markets that you don't have that equal playing field. So everybody can participate. So that's great. But everybody has this illusion about price. It's like, well, I can't afford a Bitcoin. You don't need a Bitcoin. You just buy whatever you want to do. That is the entire game here. And you've got the two issues. One is you want to be a degen. So give yourself space to be a degen without destroying your capital. The other one is don't lose your capital. So I'm going to give you the story of how I got into Bitcoin and the mistakes and things I thought I did right that I did wrong. So I bought Bitcoin first time in 2013 at $200. It went up 5x in 3 months. I'm clearly the best trader that has ever lived. And George Soros is going to have to stand aside, hire me at Soros Fund Management because I'm going to run the business now because I'm so good. It then falls, but my thesis was 5 years plus, right? So I had a long-term time horizon, and time horizon matters. So it then fell 85%. And I'm like, oh, well. And I had a long-term thesis. So I said, well, I need to allow it to play out. I knew how much money I'd risked. I took it like an option, i.e. I could lose the money and it wouldn't matter to me. But if this worked out, my thesis was Bitcoin can go to $1 million in 10 years plus. It went down 85%. I kind of ignored it because I'd written the money off in my head. And then by 2017, it was at $2,200. So I was now up 11 times my money. I was like, wow. And I'd suffered an 85% drawdown and I was still up. I'm like, wow. And then there was a lot going on in the space. And I was worried that they were going to fork Bitcoin into these various different chains. There was a lot going on. It's called forking wars at the time. And I lost faith. I was like, I don't understand this. and I should get out. And I kind of stand by that, but I probably didn't understand enough. So I got out. It went up to 20,000. So it would have gone up another 10x from where I sold it. But I was happy. I made 11 times my money. It's been a great bet. It then went to 20,000. It then went all the way back down, 85% again, or whatever it went down. And I kept it on the radar screen. And then eventually in 2020, because I still believed in it, and I saw that this forking stuff that got me worried was a false dawn, but now the prices were lower. It's like, great. If you say, well, I'm buying this NFT because I think it's going to go up 50% in price over the next 6 weeks because it's a hot project, fine, write that down. And if it doesn't meet your criteria or it does the opposite, you close it. With the long-term investing, you need to say, my time horizon is, I want to be in this trade for 5 years, 10 years. My objective is to add when it sells off more than 20%. Every time it falls more than 20%, I'm going to add some. And whatever it is, and I'm really wrong if this happens, write it down and then refer to that every time you think you're about to trade and do something. Because you forget, which I forgot. I forgot that the long-term objective was, because the money was worth more, so I'm like, well, I should save that money. I could take that money off the table. But I actually destroyed my future returns by doing that. And yes, I could have been right, and maybe everything had fallen apart and I would have taken the money off and I looked like a hero. If you're not in it, you won't win it. And that is not true of the small tokens, because we don't know what's got network effects, i.e. what's going to last. Are people going to build on it? That becomes speculation. That's okay, but you need to understand what you're speculating in. But if you're putting your bulk of your savings in, go for stuff that's proven. So right now, Bitcoin and Ethereum are the most proven. Like Solana has mass adoption, but it has issues like the chain break. So you wouldn't want to put all your money in Solana, but if Solana wins the game of mass adoption, okay, they're going to do really well. If Avalanche solves it for speed, they will do really well, but they're yet to be proven by gigantic networks. So Ethereum is transitioning to what's known as proof of work, where you get a bunch of miners, which is computers that crunch really complicated maths, use massive amount of energy to prove a cryptographic puzzle, and they get paid. What they're doing is validating the network, and that's how Bitcoin works. And it's very safe, Bitcoin, because of it. But Ethereum is moving to proof of stake, which is different. So therefore, you stake your Bitcoin, your Ethereum, to the network to secure the network. So that means if you're a validator, you have 32 ETH or more, and you get to validate the network and you get paid a yield for it. So the network pays you out of the network fees. And it's a different way of approaching the validation of all of the on-chain activity. Ethereum's no small thing. I mean, it is a gigantic kind of world Web3 computer. So the complexity of doing this transition is one of the biggest feats of engineering, programming development engineering, the world has ever seen. It's gigantic. But September the 19th looks like it's going to happen. Now, will it be 100% ironed out? I think so, but maybe not. Maybe there's some risk.